Right now, at a 7-Eleven in Midtown Manhattan, a two-pack of Twinkies costs $2.79. In 1930, two cost a nickel and were made with real eggs, fresh milk, and actual cream. Adjusted for inflation, you're paying a 4,800% markup for zero real dairy, 58% of your daily sugar, and a 45-day shelf life engineered by private equity guys to pay off corporate debt. The Twinkies you grew up with are officially gone. What you're eating today is just nostalgia wrapped in plastic. If you walk down the snack aisle of a Target in Chicago or a Ralph's in Los Angeles, you'll notice something strange about that iconic yellow box. It sits right next to the Little Debbie Swiss rolls and the Tasty Cake Crimpets, looking almost identical to the snack you remembered from school lunchboxes in 1988. But if you turn that box around and actually read the fine print, you realize you are looking at a crime scene of modern food engineering. Back when James Dewar invented the Twinkie at Continental Baking in 1930, he had a very practical problem. His bakery machine sat completely idle outside of strawberry shortcake season. So he took those spongy shortcakes, stuffed them with banana cream, and sold them two for a nickel. They contained real milk, real eggs, and real sugar. Because it was actual food, a Twinkie only lasted 2 or 3 days on the shelf before going stale. Back when World War II forced banana rationing, they switched to vanilla cream, and Americans fell in love with it. Fast forward to 2026, and that 3-day shelf life has been stretched to 45 days. There is zero banana, zero fresh milk, and zero real cream inside that sponge cake. Instead, you're paying $2.79 for a cocktail of polysorbate 60, red 40, potassium sorbate, hydrogenated tallow, and high fructose corn syrup. If a biologist looks at the rings of an old tree to understand climate history, you can look at the ingredients list of a modern Twinkie to see the geological decay of the American diet under corporate ownership. What makes this a complete shakedown for your wallet is the stealth price hike known as skimflation. You are paying top dollar for cheap industrial substitutes, while Hostess charges you nearly $3 for 2 sponge cakes stuffed with flavored vegetable fat. Let's look at their competitors. Over at an H-E-B supermarket in Houston, Texas, a 12-pack of Little Debbie Swiss rolls costs just $2.19. That breaks down to less than 18 cents per cake. At a Wawa in Philadelphia, a pack of Tasty Cake Crimpets sells for $2.49 and still uses traditional wheat and bakery butter blends that taste like actual food. Suspicious. Why is there such a massive gap between these brands? Because Little Debbie is owned by McKee Foods, a family-run business that never took on billions in private equity debt or filed for bankruptcy. Hostess, on the other hand, spent the last 50 years being passed around by corporate raiders like a hot potato. Every single owner squeezed out a little bit more quality to pay off their own acquisition loans. Cynically, when you buy a box of Twinkies today, more than 30% of what you pay goes directly toward paying off the historical corporate debt and private equity markups of the companies that gutted the recipe. You aren't paying for flour, sugar, or cream. You are paying for Wall Street financial engineering. So how did a 5-cent cake made with real dairy turn into a 45-day chemical package? The answer isn't in a bakery kitchen. It's in a bankruptcy courtroom in Manhattan. To understand how your childhood snack turned into a chemical package, you have to look at what happened in a bankruptcy courtroom in Manhattan. Back in September 2004, Interstate Bakeries, the company behind Hostess, filed for Chapter 11 bankruptcy. It was one of the largest food industry bankruptcies in American history. On paper, they had built a massive distribution empire, reaching 50,000 retail outlets almost every single day. But beneath the surface, the company was suffocating under a mountain of structural debt. They had 372 different collective bargaining agreements, 12 different union contracts, and a staggering $2 billion in unfunded pension liabilities. Every time previous executives sat at the negotiating table throughout the 1970s and 1980s, they pushed the bill down the road. They promised pension payouts 40 years into the future because it was easier than dealing with immediate labor disputes. By the time 2012 rolled around, Hostess filed for bankruptcy a second time, with $900 million in assets and $1.4 billion in debt. While 19,000 factory workers and truck drivers were facing devastating job losses, the executives running the company into the ground were securing massive pay hikes. The chief executive received a 300% raise to $2.5 million a year, and the company convinced a bankruptcy judge to approve nearly $2 million in executive bonuses just to stick around during liquidation. Grimly, when the Bakers Union went on strike in November 2012 to fight against deep pay and pension cuts, Hostess shut down 33 bakeries and liquidated the entire operation. 82 years of continuous Twinkie production vanished overnight, and thousands of middle-class bakery workers lost their livelihoods. That is when Wall Street stepped into the wreckage. A private equity firm named Apollo Global Management teamed up with C. Dean Metropolis and Company to buy the brand assets of Hostess out of bankruptcy court for $410 million. Private equity didn't buy the old company, the union contracts, or the $2 billion in pension debts. They bought the brand name, the recipes, and 5 remaining bakeries on a completely clean slate. They immediately slashed the workforce from 18,500 employees down to just 1,000. They dismantled the legendary direct store delivery truck network that got fresh cakes to stores within 3 days. Instead, they shifted to a centralized warehouse distribution model. That single move cut delivery costs from 33% of sales down to 16%. It was a massive win for Wall Street profit margins, but a disaster for the product itself. Because central warehouse shipping takes longer, a cake couldn't just sit on a shelf for 3 days anymore. To make this new business model work, private equity engineers had to stretch the shelf life from 3 to 45 days using chemical emulsifiers, artificial preservatives, and zero real dairy. In 2016, Apollo took Hostess public on the stock market. Their original $410 million investment suddenly exploded into a valuation of $2.3 billion. That was a 500% return for a handful of private equity managers running spreadsheets in Manhattan. But that gain didn't come from innovating a better cake or creating new value for consumers. It came entirely from breaking promises to workers, stripping out real ingredients, and charging shoppers full price for a degraded product. The financial flipping didn't stop there. In September 2023, the food giant J.M. Smucker got into a bidding war and bought the entire Hostess brand for $5.6 billion. The corporate executive stood on stage, ate a Twinkie, and declared that the acquisition tasted like growth. But when a corporation pays $5.6 billion for a brand that was worth $400 million 10 years ago, guess who actually pays for that $5 billion markup? You do, every single time you check out at a store. To justify that astronomical price tag, corporate owners have to keep squeezing the consumer. They raise retail prices by 40% while using cheaper chemical substitutes to preserve margins. Ironically, Smucker thought they bought a perpetual money machine fueled by American nostalgia. But as we head through 2026, corporate executives are realizing that shoppers are striking back in a way Wall Street never predicted. By early 2026, the financial reality behind the corporate snack empire started crumbling. J.M. Smucker's sweet baked snacks division lost over $270 million in a single quarter. The $5.6 billion bet on nostalgia hit a brick wall created by 3 massive forces in American culture. First, tens of millions of people across the country started using weight loss and diabetes drugs like Ozempic and Zepbound. Studies show that patients taking these GLP-1 medications reduce their overall snack and junk food purchases by 40 to 60% overnight. Second, stubborn inflation forced middle-income families from Phoenix to Atlanta to trim their grocery receipts, cutting out non-essential treats first. And third, 76% of Americans now report that they are actively trying to consume less refined sugar and artificial preservatives. Wall Street tried to charge higher prices for a cheaper chemical product, but ordinary shoppers simply stopped reaching for the yellow box. If you want to protect your wallet and your health during your next grocery trip, you need a practical protocol to spot these corporate skimflation traps before you reach the register. It starts with the 3-second label rule. When you pick up any packaged snack at Target or Walmart, turn it over and look at 2 specific indicators. If hydrogenated oils or artificial preservatives like potassium sorbate appear near the top of the ingredients list, or if a baked product advertises a shelf life longer than 21 days without refrigeration, put it back on the shelf. You are not buying fresh food. You are buying a chemical shelf-stable formula engineered to reduce shipping costs for the manufacturer at the expense of your health. Next, run the real calorie cost ratio. At a convenience store in downtown Chicago, paying $2.89 for 2 Twinkies gives you 260 calories of empty sugar and hydrogenated fat. That works out to roughly $1 for every 90 calories of junk. But if you walk into the fresh bakery aisle or look at store brands like Great Value at Walmart or Kirkland's Signature at Costco, $2.19 buys you over 1,200 calories of real oats, whole grains, or fresh bakery goods. You are paying a 300% premium for industrial chemical filler just because it carries a famous 50-year-old brand logo. Finally, execute the family-owned alternative swap. When you crave an occasional treat, look for brands that remain family-owned or regionally operated without private equity debt. A box of Little Debbie Swiss rolls from McKee Foods costs $2.19 for 12 cakes because the company doesn't need to bleed profit to cover billions in acquisition loans. Local brands like Drake's or regional bakery items offer far better value and simpler recipes. Swapping out high markup corporate snacks for honest alternatives can easily save an average household between $150 to $300 every single year. You take control back from Wall Street simply by choosing where your money goes. So why are these massive conglomerates still trying to push these chemical snacks on us, even when they are losing hundreds of millions of dollars? When a corporation pays $5.6 billion for a brand that is losing market share, they do not respond by making a better product or returning to real ingredients. They respond with desperate marketing tactics to squeeze every last drop of revenue out of remaining buyers. In late 2025 and heading into 2026, J.M. Smucker started testing targeted placement strategies in cities like Denver, Colorado, and Los Angeles, California. They began positioning Twinkies displays directly adjacent to licensed cannabis dispensaries, hoping to catch consumers experiencing late-night appetite cravings. When you cannot convince health-conscious parents or grocery shoppers to buy a bag of shelf-stable chemicals, you target impaired consumers who are not reading ingredient labels or checking price markups. This is the logical endgame of short-term corporate ownership. Every single owner of the Twinkie brand over the last 50 years chose the exact same playbook. They cut costs through shrinkflation, ruined product quality through skimflation, and spent millions on nostalgia-driven marketing campaigns instead of investing in honest food. They banked on the idea that Americans would forever pay premium prices for a memory from their childhood. But there is a fatal flaw in relying on nostalgia to sell junk food. Nostalgia eventually expires. Gen Z and Gen Alpha shoppers in 2026 did not grow up watching Howdy Doody or seeing Twinkies handed out at 1980s roller rinks. They grew up in an era where sugar awareness is everywhere and food ingredients are analyzed on social media in seconds. They have zero emotional attachment to a yellow sponge cake that tastes like vegetable oil and artificial flavoring. You cannot sell a multi-billion-dollar brand on childhood memories to a generation that never had those memories in the first place. Nostalgia is an expensive trap designed to make you overpay for industrial waste. At the end of the day, you hold the ultimate power every time you step up to a checkout counter. The Twinkie you grew up with did not survive the corporate courtrooms of 2012. The original snack, made with fresh bakery ingredients, real eggs, and actual dairy, is gone forever. What sits on grocery shelves in 2026 is a financial vehicle wrapped in yellow plastic, engineered purely to extract cash from nostalgic memories while servicing Wall Street debt. When you spend your hard-earned money at the register, remember that every dollar is a vote for the world you want to live in. Paying premium prices for degraded chemicals tells corporate conglomerates that they can continue stripping quality out of everyday products without consequences. You strip away their power the second you refuse to buy into fake nostalgia and choose honest, real value food. If you want to protect your wallet from hidden corporate markups, skimflation traps, and systemic price hikes, make sure to subscribe to Save Hundreds. We break down the real math behind the products you buy every day, giving you the exact protocols to save money and stay ahead of corporate greed.